wife's going to kill me today. My birthday present, honey, is leniency. The warden, I'm asking the warden for leniency. Please be lenient with me today. I'm in my moment, okay? I have to do this to my completion, and then I'm satisfied. Because if I leave it and I don't say what I want to say, I won't be able to enjoy my time with her and my family because I'll be thinking about this because I'm obsessive. This guy's a real jerk, man. He's putting trading before his wife and kids. That's been my whole life, and that's why I'm not the best mentor. So we have the low of this candle and the high of that candle, and the single pass through at sell side delivery. Inefficiency is on the buy side. That means until this candlestick here, that high, the difference between that and this candle's high, that is your inefficiency still. Okay, so it looks like that. And what does it do? It trades up just above that on this candle there. But why did I pick this fair value gap? Why did I do that? Well, if you go back and look at where we were here before 8:30 started to run up, I measured in front of you this high, dragging the Fibonacci down to here. The only use of a Fibonacci for me is I want to know where the midpoint is. That's all Fibonacci does for me, because that determines if it's overbought or oversold. I don't need an indicator to tell me that. You don't need an indicator to tell you that. And divergence on any indicator is useless. It doesn't mean shit because you're compressing numbers. And if you beat and torture numbers enough, the data will submit to anything you want it to say. So it's a matter of looking for where are we at in the range. So can you see clearly that this is the range high all the way down to that low? So the most recent large degree of directional movement, right at 8:30 as it happened, where was the profitable trades being held? The longs or the shorts? Predominantly it's the shorts. Why? Because it's been the most recent protracted directional move and it's been going lower. So when we have these big ranges like that, it's important to measure with the fib. That way, if you're going to go long, or if you're anticipating it's going to go long, why would we anticipate that? Because what I gave you yesterday as guidance, I'm gonna slap you around a little bit, and you say stuff like this. I got to get it out of my system. But 50% is here, so that's equilibrium. So at that level or below is discount. At that level or above is premium. So we're here at 8:30. I taught you yesterday that if there's clustering with the new day opening gaps and a new week opening gap, if that's above where the market price is and you're anticipating price to have a movement, one directional, okay, or high impact or medium impact news drivers are likely to create a spooling in price where they start gapping price higher. And you see that in that 15-second chart where it traversed over 100 handles in 15 seconds. And you think that's buying pressure. It's not. That's absolutely algorithmic. It's them repricing. Now, before the markets were electronic, there would be a group of men that sat around and they would pair orders. If you remember back in times where I was teaching on baby pips, they're pairing orders. What does that mean? All they need is one trade, one contract to book price. That's it. So if they have an intention of repricing to 18,165 when price is sitting at 17,973 and it wasn't electronic markets, so the algorithm was all future. They can't do it yet because it's not automated yet. We don't have the technology to do that. So everything's open outcry. What they would do is they would sit in a room. One man would put an order in, okay, I want to buy at this price. And another guy would say, okay, I will agree with that price. And they hurry up and they stair step it just like that. And that would feed that price run. So that way the price would book on your chart before electronic trading. And they just kept prices moving just like that. And you can see it, and you can validate it with volume. Just look at volume. How many contracts were traded at 8:30 to make that 100 handle run? When I get done showing this again, I'm going to drop down into like a 1 second chart, and we'll look at that first 8:30 to 8:31 movement with a 1 second chart. It's illuminating. So because we have equilibrium here, and I'm anticipating based on the logic I taught you yesterday, if the market's here before the news driver is going to be the retail's excuse for why price went up. when it's not. It's just the highlighting of the time when the market's going to start spooling. Spooling is just like when you have a fishing rod, okay? And you put your little anchor, your little sinker on the end of it with your bait and your hook, and then you cast the fishing rod out into the water. The fishing line, when it starts leaving that spool, that reel of fishing line, as it's going off that reel, it's shooting off, but it's being unraveled real quick, and it's shooting out the length of the fishing pole and out into the water. That's exactly what's going on when the algorithm starts running. When it enters into a buy program, boom, it starts spooling higher. When it enters a sell program, boom, it starts going lower. Your task is to understand the characteristics when the time is likely to see that unfold. When there is no market driver, when there's no news, like at 8:30 or 10 o'clock reports that come out, or sometimes there's a 9:45 number or 10:30 if it's crude oil inventory. When you have all those reports or those times of the day, they're pretty generic. Everybody knows that. But there also are things like I taught as a macro. It's the first 10 minutes before the top of the hour and 10 minutes after the top of the hour. The market will spool there as well. They'll start running. What is it running for? It's running for liquidity or rushing to get into an inefficiency. You probably hear Bailey in the background barking. I apologize. I think it just got a delivery. And thank you for the birthday cards, by the way. I actually too many of them to show. I showed one of them, Moses. Thank you again. But I just don't. I know some of you probably would like to see your stuff show up on my community post. I don't want to do that. But that day I just got one, so that was nice. The the fair value gap that I chose here is above the equilibrium price point. Okay, and it's also inside of that breaker. And if it's going to trade above this, where could it trade to as an upside target? This area here that could act as what? The inversion fair value gap. So it's those levels we look for. Okay, so how can we use this information in a trade idea? Let's go back down and get this Fibonacci off.